Hello and welcome to the latest quarterly review of the AJ Bell Funds, where we'll recap the end of 2022 and look forward to the rest of the year in 2023. Let's start with shares, which across the fourth quarter of 2022 outperformed bonds, returning 1.9% on a global average against bonds which returned negative 3%. It was a particularly strong quarter for European shares, with the market made up of many banks and healthcare companies and helped by a strengthening euro. On the other end of the spectrum, the US was down in pound sterling terms due to a weakening of the currency, meaning that dollar-denominated assets were worth less when converted back into pounds. This follows a year of sustained strength in the US dollar, with the Federal Reserve setting the precedent for rising interest rates across the developed world. Looking back over 2022, there can be no doubt it was a tough year for investors. Bonds usually offer some protection during market downturns, but this wasn't the case last year. Central banks have been laser focused on fighting inflation and as a result increased interest rates across the world. This created a negative environment for bonds, particularly as the speed of the rate increases surprised investors. However, as bond prices drop and interest rates rise, their yields also increase. This means that forward-looking expectations are much improved from a year ago, something especially true for riskier bonds issued by companies rather than governments. As a result, we've increased our allocation here to take advantage of these higher yields. Compared to the IA sector averages, our funds have performed relatively well over 2022. This was in part because we took less interest rate risk in our bond allocation out of an expectation that interest rates would rise. This strategy paid off when interest rates rose as expected. Another area of strong fund performance at the higher risk end was our allocation to energy companies and businesses with strong pricing power in both infrastructure and consumer staples. As these positions made good returns in 2022, we've now decided to take profits in these areas. Looking forward, the spectre of inflation hasn't yet been banished, but improved outlooks in shares and better starting points in bonds can lead to some optimism for investors. As ever, we remain ready to utilize all the tools available to us to ensure that your money continues to work hard for you. Thanks for watching.